Welcome to the Money and More podcast with me, your host. Over the next few episodes, we're going to be joining forces with XTB, who are on a mission to help investors create wealth for the future. We're going to be delving into three very specific topics, which I think are going to be very informative, very educational, very interesting to talk about, really. This is the first episode where we're going to be focusing on monetary policy. I'm joined by Research Director Kathleen Brooks of XTB. Thank you so much for joining us for this episode of the podcast.
Oh, thanks for having me, Peter. It's a joy to be here.
Thank you. So, first and foremost, actually, what does a Research Director for XTB actually do? What's your day-to-day?
So my day-to-day is, we start quite early and I scan the markets, see what's been going on during the Asia session, anything at the end of the US session as well. We then write reports that go to our clients, that sometimes go out to the media. So when you see our quotes in the business press, these are kind of the views and the thoughts and the themes in the markets that we're gathering all the time. And we try to condense that down to make it really easily accessible to our client base.
So I guess it's an ever-moving ball, essentially.
Oh, it really is.
You're constantly having to juggle.
Oh yeah, there's not one formula. You think you've got the formula and then something else happens and it changes it all.
So here's the first question for you on this, just for the benefit of people who may be watching this and listening to this on Spotify. What are the primary goals of monetary policy, and how do central banks kind of like balance their objectives in different economic conditions? We've just had inflation, for example. Yeah. So what's their thinking around this? What's the whole goal with this?
So there's a few goals that central bankers have. Stable inflation is really important, as we know recently. Keeping unemployment low is also actually one of the main targets for the US central bank. It's not an actual written down target for the UK, for the Bank of England, but it's still something that they will absolutely consider. Where is unemployment at? Where's inflation at? Where's that going? They've got to essentially sustain an economy, and they also have to protect the value of a currency. Now that's less of an issue for us here in the UK, in Europe, even in the US, but over in Japan, they watch the yen very, very closely. And when they think that it's either moving in too volatile a way, they will actually step in and either buy it or sell it, depending on what's going on. Usually they're buying it, because if the yen gets very, very weak, that threatens inflation in Japan. Yeah. So that's what some central banks do. But essentially they're very dependent on economic data and on market movements. And that's really how they determine where monetary policy should be. So for example, we've seen a really high inflationary environment. We had to see the central banks, they were considered to be behind the curve. Now, what is this curve that people are talking about? Is essentially where people think interest rates should be for the economic environment, for where inflation is, for where unemployment is at. And post the pandemic, we had very high inflation and we had very low levels of unemployment. And that was seen almost like an inflationary bomb that had gone off in the West. So they had to very quickly hike interest rates. And that's why we saw interest rates rise to these multi-decade highs at the fastest pace that we've seen since the 1980s. And they had to do that so that they were adjusting policy for the conditions of the economy right then, because we had this big shock with the pandemic, inflation surged. They need to hike interest rates to try to bring inflation down. They have managed to do that. We are seeing a disinflationary trend, but I'm sure all your viewers know as well, things are more expensive now. So,
100%.
So it's a really hard job. So if you're thinking about becoming a central banker, it is not easy at all, but I'm sure you're all up for the challenge.
It's weird really, because in the conversations that I have and the questions I often get, the main criticism that is labelled at the likes of Andrew Bailey at the Bank of England is, you're behind the curve. Like, surely you should have seen this coming, or surely you need to anticipate this a little bit more. And it's like, how big is the goal here, and where's the goalpost exactly? Because you don't have a crystal ball. You're kind of reactive to a certain degree. And I don't know whether it's just something that maybe it's because people just are mistrusting of the government as a whole, but it doesn't feel like there's a lot of confidence in the fact that the guys at the Bank of England are looking at certain things and they're reacting according to what's going on with the aim that they can bring inflation down. I don't think necessarily that if you speak to Joe Bloggs on the street, that they kind of understand that equilibrium that they're trying to kind of get to.
I would agree with that sentiment completely. For so long, none of us really worried about central banking, really, or about what central bankers do. And that's because interest rates were very low. In fact, it was very boring. They didn't really do much for very often. And then this pandemic happened, and out of nowhere, we hadn't had one for 100 years. Central bankers it is a bit of an impossible task. Now, the impossibility of the task is twofold. Firstly, because as you correctly said, the goalposts are always moving. Economic data can fluctuate from one month to the next, but actually you've got to look at a wider trend, so they need time, and they're always asking for time. That's the thing. But the other thing is that they are also trying to manage things that are totally out of their control. For example, yes, we had a post-pandemic inflation spike, but we also had Russia invade Ukraine. That caused commodities around the world to spike. They can't stop Russia from doing that. They can't stop they can't impact the global commodity prices particularly well. And yet they're being asked to bring down our inflation. And the vast majority of our inflation leads back to those globally priced commodities.
Yeah.
So it is really difficult for them. The other thing I think is that we're in a 24-hour news cycle now. And what central bankers really do get caught in the crosshairs of that as well, particularly when interest rates are going up, because no one wants to pay more for their mortgage or borrowing or anything else. So they are really scrutinised, much more so than they probably were 10, 15 years ago when interest rates were very low. So every single word that comes out of their mouth can impact the markets, can essentially push up a interest rate that you might need for your mortgage, remortgaging or something. Yeah. So they've really got to hone in on their communication. They've probably got work to do on that, I would say. I think even the Bank of England would agree with that. They're not designed to, a lot of central bankers, they're economists. Yeah. And so they're not necessarily trained communicators, and they've got to work on that.
Yeah. I think that, is it a TikTok or an Instagram account they've literally just started? I found it the other day.
They're behind the curve on that.
I know, well behind the curve. I mean, obviously I follow financial content online, and I remember seeing the account and I followed it. But it was, I think the first video was basically just Andrew Bailey saying, hey, we're on Instagram now, we're going to be sharing some of this information. I'm like, you need a strategy for that, really, to be fair. You need to
and I mean, for those of us old enough, they have actually made a lot of the content on the Bank of England website much more usable. I mean, 5 years ago, it was so much harder to waft through all these different reports and their forecasting was very, very difficult to see. But they have made strides on that side. I will give them that.
A question I have for you here is, how does the direction of monetary policy, they talk about tightening and easing, how does that influence the investment strategies for investors? How do you see it as a business that works in the investment landscape?
Yeah, I mean, by and large, you want to kind of try and stay invested so that you don't panic. That's kind of the main key thing. But there are certain strategies that you can do. And we saw that really at play certainly back in 2022, when interest rates were just all moving higher. There was almost a synchronicity about it in the West. And when central bankers are tightening interest rates, so they're increasing the cost of money by raising interest rates, you tend to see more defensive actions. So people will sell tech stocks, for example. It was a terrible year for tech. It's hard to remember now, but it really was a terrible year for tech back in 2022. Great year for the FTSE 100 because they have those energy and those defence firms. But defensive sectors are sectors that are seen to do well in more difficult times, more challenging times. So when money isn't that openly available, that's energy, that's utilities, that is defence firms, and we have a lot of them in the FTSE 100, and so the FTSE 100 did really, really well. When they're loosening monetary policy, like what we've seen certainly since the start of this year, a lot of expectation that central bankers are going to loosen policy, you tend to see that as being a really good time for risk assets. So even though central bankers haven't actually cut any interest rates yet, the Q1 of this year had a blistering rally, particularly in the US and parts of Europe and in Japan. And that's because you tend to see those growth sectors. So the tech stocks do really well. Consumer stocks do really well because they see it as lower interest rates. Well, that will make the consumer a little bit more confident. They'll be willing to go out and spend a bit more, and that will boost economic growth. So it all kind of, this perfect kind of confluence of factors that really help stocks in Q1 and boost risk sentiment. Now, what's interesting now as we get into Q2, there's a little bit more caution that's come back into the market because investors and traders, they're recalibrating where they see interest rates going. And maybe those central bankers won't actually cut interest rates as quick as some had expected in January because inflation has been surprising on the upside. Yeah,
that's interesting what you say there, because I'm getting asked all the time, what do you think is going to happen with interest rates? And I think when you look at a lot of the language that is out there, I mean, oftentimes they will that will kind of signpost what they're going to do, what to kind of expect. But it's always a moving target, essentially. And I've been saying, probably Q2, beginning of Q3, before we start to see anything happen with the base of England base rate to kind of move. But on an investor's point of view, it's interesting how you talk about the fact that things have shifted slightly. Defensive stocks that are more kind of like traditional in the sense and not maybe in that growth tech sector. And I always talk about the fact that it's always something that if you're an investor, you need to consider how you diversify your portfolio to ensure that you have not got something that is too antiquated towards one particular thing that is, I guess, as suitable as it can be for all kinds of seasons. And I think monetary policy being the reaction that the government kind of gives to whatever is going on globally in the world when it comes to inflation and the money supply, these are the things that I think are important for investors to understand, so that when they're looking at their investment portfolio, they're taking informed decisions. It's not just something that happens out of the blue and all of a sudden it's a complete and utter surprise.
Yeah, I think that's completely true. And I think you've just got to look at some of the really hot stocks at the moment, like Nvidia, for example. That has just been going gangbusters this year. And it has had a blistering year, fantastic rally. It's up about 80% thereabouts. But it's been incredibly volatile. At one point, it was more volatile than Bitcoin. So you've got to balance it all. And that is saying something. So you've got to really balance it out. And I think you're right, just diversify. Because central banks, they have to be data dependent because it's a moving target, as you really eloquently said, about what they're trying to do. So they have to be data dependent, which means that their views or what they're saying can shift from one month to the next. If you've got a diversified portfolio, then you don't need to worry so much about what they're doing. Because if you're just putting all your eggs in one basket that requires central banks to be cutting at this point and the economy to be doing this at this point, you're going to be very stressed.
Absolutely. In the context of historically low interest rates, how could investors adjust their portfolios to mitigate risk and kind of capitalize on the opportunities that might be coming down the stream? Because I think when you look at the markets, generally speaking, you can see it in two ways. Like, it's either going to be horrible or there are opportunities that you could potentially position yourself for. And I think that is a mindset thing for sure, not just looking at the markets as this thing that it's horrible, I'm going to lose money. But you need to have that pragmatic view. Yeah, there are risks that we can kind of mitigate and try and manage and balance for, but there's also opportunities. How do people kind of position themselves in that regard with regards to what's going on at the moment?
Well, I think the mindset bit is really, really important. So when you're in a low interest rate environment, like we were for a very, very long time, pre-pandemic, you essentially want to be involved in higher yielding assets. Because if you're going to just leave your money in a bank, then you're not earning anything on that much. It's going to erode it. So you're better off going into high yielding assets. And what we saw in the last kind of 10, 15 years is we did see the emergence of some of these really big tech firms really come to dominate. I'm talking the likes of Meta, obviously Nvidia, Apple and Microsoft are some of the oldest companies in the S&P 500 actually. They've been around a hell of a long time, although we call them kind of the tech giants, but they're actually more like S&P 500 dinosaurs these days. But, we saw those companies really, really come to the fore. And we've seen that in the last kind of year and a half as well, where they've been dominating. One thing that I think has changed over the last 6 months is that, when things get really expensive, be it a stock, for example, some people start to take note. They're like, am I justified at paying that price for it? And when you get to that point, then you see the rally broadening out. And what really helps the rally to broaden out is the prospect of lower interest rates, because that really helps all of the market, because companies can borrow at a cheaper level. That will help them grow, help build their profit and their bottom lines. So when that happens, I think you get a broadening of the rally. And that's actually when the fun starts, because you're seeing, for example, Q1 earnings season is not just all about tech, although tech are expected to do amazingly well in the US anyway. But we're also seeing upgrades to profit forecasts for utility firms, for healthcare stocks. In the UK, energy stocks, as the oil price has risen, over 20% so far this year, you're seeing earnings revisions higher for energy stocks as well, and for those oil companies. So that can have a real broadening effect. And then you can really see kind of almost like I'm not saying that markets move in unison, because they absolutely don't, but you don't then just have to be invested in one side of things. It feels like a little bit more even, a little bit more equilibrium has returned to the market.
Yeah.
And that's really what you want, because you don't want to be putting your money in a bank and leaving it there, because you're not going to end up building it in any way. If you want to help build your wealth, then, do what the likes of Warren Buffett do. They keep very little amount in cash and they invest it. They invest, and stay invested.
Yeah, and that kind of leads very nicely onto the whole segue and the whole point of why we're with you sat in these podcast episodes is the fact that with XTV, one of the main things that you guys have launched recently are the investment plans.
Yes.
And I think this is very, very topical in regards to this topic, because if we're talking about, we can't control monetary policy, which is just fact. The Bank of England are going to do what they're going to do. The government's going to do what they're going to do. Russia and all these external players are going to do what they are going to do. I'm a big fan of controlling what you can control. And if, as we've spoken about here, diversification, making sure that you understand how the landscape essentially lies, so that you're positioned properly, things like the investment plans are great, because you can pick different ETFs for a portfolio across different ranges, global exposure, so on and so forth, sectors that can help you build something that is actually going to work for you, hopefully in the long term.
I would completely agree. Investment plans is a fantastic product for that reason. Very easy to navigate, but it's a great way to stay invested. So if you look at throughout history, at the direction of, let's just say the S&P 500, but by and large, you could say it for most indices, they move higher over the long term.
Yeah.
So yes, there are dips. And that's when, we've seen it, I've seen it because I've been around for quite a while, but the financial crisis, everyone thought, oh my goodness, this is hell. We're going to see all the banks collapse. Everything's going to be terrible. That didn't happen. Yes, some did collapse. But actually there were policies put in place, the market bounced back very, very quickly and continued to bounce back.
And achieve new highs.
Absolutely. Yeah. And we see that all the time. The S&P 500 rose to a fresh record in Q1. It's only about 1% down from its record high. And yet there's a lot of noise in financial markets, and it's really easy to get caught up in that. But the thing is, when you've got something like investment plans, you put your money in, you can check your balances, things like that. When there's panic in the market, I think change your mindset. Find out what that is. If it's general panic, it's not about the actual company that you own or whatever else. If you own a diversified portfolio, ride through it, right? Everybody's there. We've got a whole ecosystem designed to support our economy so it doesn't collapse. For example, we've just spoken about central bankers. They're designed to sustain economies. They're some of the most important people in the world.
That's their remit. That's their job.
That is their job. And they're the brightest minds are all on that. Government's the same. Yeah. So just ride through it, because if you bail when things are really in panic mode, you are going to be selling at the low. Someone is happily going to snap that up from you, and they're going to ride the high. Yeah. So you've got to really be smart during those periods. It can be uncomfortable. And like anything in life, there are periods where it's of discomfort. But I would say in my kind of near 20 years now of working in financial markets, those periods are generally quite rare, and we're still here. The economy is still expanding. Stock markets are making record highs. I'm not saying that things are absolutely perfect, that every company is doing brilliantly. It's not. That's also the case. But see it as an ecosystem, treat it holistically, and be calm.
Yeah. I would agree with all of that you just said there. And that's the difficult bit. We are going to talk about investor psychology a bit later on, so we can delve into that a little bit further on there. Final question for you then. Looking forward, what emerging challenges and opportunities do you see for monetary policy?
Oh, I think it's really interesting, because I think we're at a very interesting point. Economic resilience is high. Commodity prices are high, and central bankers have started to speak about how they are starting to feel comfortable about potentially cutting rates, signaling it. We had the ECB signal that they were going to cut rates in June. I think that will happen. And they are going to signal that more as we get closer to it. But in Davos, Christine Lagarde said maybe in the summer they could. Now, she would say that her words were a bit twisted, but that's quite a a directional comment for a central banker to make. You can argue that, Europe is struggling more. The parts of some of their economies, Germany in particular, has really been struggling because of high energy costs, slowdown in manufacturing. So you could see that happening first. I also think that, in the UK, Andrew Bailey actually was one of the most hawkish central bankers for a very long time, much more hawkish than the Fed and the ECB. And in fairness, until recently, we had two members voting for rate hikes, although they've shifted their tone. And I think Andrew Bailey's shifted his tone as well. There is a disinflation trend in the UK, so I think that they will also cut interest rates. But the US is really on its own. It's standing on its own for now. So I think whereas the market likes everything to happen all at once, so all central bankers to move together, what we'll probably see is the Bank of England and the ECB cut rates first, and in a few months, the Federal Reserve will follow. Now, some people, there's a lot of synchronicity in the market at the moment, including with sovereign bond yields, which suggests that they're all going to cut on the same day at the same time. I don't see that happening. And I think we've got to go rewind all the way back to 2021, December 2021. It was the Bank of England who started hiking interest rates first, then the US, and then the ECB. So they usually move around about the same within about 6 months of each other. And I think they'll do this time. I would probably put a 30% probability of the Fed not cutting this year. But I think if they don't cut this year, they'll cut very early in 2025.
That's interesting, because I think when you look at what Jerome Powell and the Fed have kind of done, I don't know, it almost felt like to me, like they were kind of on the pulse, maybe just a touch earlier than everybody else. And kind of what they introduced has kind of worked really effectively for them. And so, it's been interesting, really. But they've got the election cycle coming up at the end of the year. So that's going to be another point of
They might want to keep quiet around that. I think the other thing is that they, with Jerome Powell, yes, and he's maintaining this rhetoric of loosening rhetoric. Like, yes, we are going to, I don't see higher inflation stopping us from cutting rates. The Fed's dot plot is saying 3 cuts this year, although the market is now only expecting 2 rate cuts. Maybe they don't want to be let down again, because it wasn't that long ago they were looking for 6 to 7 rate cuts from the Federal Reserve. The one thing I would say though is Jerome Powell, he had, the goalposts are moving with his communication as well. I'm old enough to remember when he said that inflation would be transitory.
Yeah, I remember that. I covered that as well. And it's what does that mean exactly?
It's, what they do and what they say can sometimes be different things.
Okay, final question actually for you, because I think people will be interested on this. What do you think interest rates in the UK will kind of level at? Because I think there's a part of the population that think we're going to get back to the 1% mortgage rates and it's going to be lovely and it's going to be cheap borrowed. And I'm like, no chance. What do you think interest rates will likely kind of settle down to once all the dust is kind of rescinded?
Yeah, I fully agree with that. We are beyond the era of ultra low interest rates. I just don't see that happening again. I think that they'll probably cut down to maybe the high fours, in the kind of first cycle. And it may be slow. It may take a year to get to that point, because we've got this very uneven inflation, which we know the Bank of England can't control all of. We've also got a very tight labour market. I think then we could see interest rates hover around at a relatively elevated level, maybe not that far below, maybe 4.75% or something for about a year before they get cut again. And I think that it will be kind of a step-by-step process, a slowly process. They hiked very, very quickly, but I think the way down it's going to be very undulating. It's not going to be a steep decline. And I think that we will, people talk about the neutral rate. That's going up everywhere. And I think in the UK, we could see it 3.5%, probably not far from the Federal Reserve's, because of, wage pressures, pressures on, demographic problems. There's so much that's feeding into all of this. Our economies have changed, our societies have changed, and that will require a different interest rate going forward.
Yeah, I'd agree with that. I think I've been saying to people 3-4s is what you kind of want to expect. But the ones, they're gone. Those days are far, far gone. And I think as a society, we need to make the monetary adjustment for that from our own personal points of view when it comes to mortgages and lending. And I think that's still a bit of a nasty surprise.
I think it
that
is as
people
well.
are not quite ready for just yet.
Yeah. I think you're right. I think that really is a nasty surprise. And I think, yes, that's going to hurt the consumer, or there's going to be a period of adjustment. I mean, my parents remember when interest rates were like 15%, and of course they think that we're borrowing, even at 5%, that's really, really cheap.
Yeah.
But obviously I'm like, but mum and dad, hang on a second, you bought your house for like, nothing. Look at how house prices have gone. So there is that adjustment to make. And I think, interest rates, central bankers need to take that into account as well. Asset price inflation is huge. But for corporations, and particularly say for banks, using them as an example, when we had the financial crisis in 2008, interest rates had to be slashed, loads of money poured into the economy, the same with the pandemic. What we've seen this time round, when we've had interest rates actually go up for the first time in decades, corporations on the whole have done very well. Now we have seen an uptick in bankruptcies, very small for personal bankruptcies, very small for repossessions of homes, and we've seen an uptick in some particularly consumer-facing businesses. And I know it's very, very hard for businesses, and this isn't in any way to lessen that impact, because I think everybody needs to be really aware of that. However, banks, for example, and other companies, they are a lot more resilient now. So it does show that maybe we do learn from the lessons of the past. Will we go back to a financial crisis? Well, actually, lending criteria is quite tight. So that's why we haven't seen a surge in repossessions or bankruptcies, because banks have employed those tactics over the last kind of 15, 16 years.
And I think that's the key thing, that when people look at things and they think about confidence in the banking system, that's one of the key things from 2007, 2008. Those things were introduced to protect against those kind of circumstances specifically. Does it protect everyone? No, because it's not a perfect system, but it's definitely worked to make sure that people couldn't over leverage, over borrow. I mean, I remember back in the day when you could self-certify your income for a mortgage. It was absolutely crazy to think that you could even do that. But those things have now been kind of like kiboshed because of the effect that it caused with, the subprime market, mortgage market, and 2007, 2008, and that whole debacle. So it's going to be very interesting moving forward, I think.
I have a bit more confidence these days that actually the fundamentals of the global economy, which then trickle down to the UK economy and elsewhere, are quite strong.
Yeah. Thank you so much for joining us for this. So, guys, we spoke a little bit about investment plans that XTB are offering at the moment. I would encourage you to go check it out. I did make a video, and there'll be other videos coming out on the channel around that specifically. But the whole point of investment plan is that you are able to invest in a way that is diversified, that is aligned with your goals and your timeline, and it allows you to almost put this thing on autopilot so that you don't have to worry about the minutia and the detail that can be a little bit of noise. In the next episode, we're going to be talking about something that is very, very interesting. We kind of touched on, there are two things we're going to talk about. We're going to talk about the US elections, because that's happening this year, and it's going to be very, very interesting. I think a lot of people are expecting a Trump 2.0 because, well, we'll talk about that later on. We're also going to talk about investor psychology, because really, as an investor, it's probably the biggest thing that you have to master, more so than the actual decision making. And by God, does it impact the decision making. So we'll see you on the next episode. Be back in a minute.